trying to navigate the investment world, it can feel a bit like staring at a thousand-piece puzzle, but with no picture on the box, right?
Yeah.
You've got all this market data, expert opinions just flying at you from all sides. How do you actually make sense of it? How do you get to smart decisions?
That feeling, that sense of being overwhelmed, it's completely understandable. I think the key isn't necessarily just finding more data.
Right.
It's really about developing the framework.
Yeah.
The mental tools to effectively analyze and interpret the information we already have.
Okay.
To ultimately spot those profitable opportunities.
Well, today we're diving into a resource that's actually designed to help build that exact framework. It's Pitch the Perfect Investment, The Essential Guide to Winning on Wall Street by Paul D. Sonkin and Paul Johnson. Yeah. And what I found really interesting about these authors is their background. They haven't just taught this stuff for years. They've actively managed money, too.
Which makes a difference.
It does. And they describe their book as a kind of survival guide for investment professionals. It immediately made me think of something like, the SaaS Survival Handbook.
Yeah, I see the parallel.
That really comprehensive guide, but, tailored for Wall Street challenges.
That survival guide analogy, it really captures what they're aiming for, I think. In the competitive, often sort of unpredictable world of finance, having a solid grasp of the fundamentals, it's just non-negotiable.
Absolutely.
And Sonkin and Johnson, they really try to provide exactly that, drawing on their deep practical experience to boil down the core concepts that drive good investment analysis.
So our mission today is to do our own focused exploration of their book. We want to pull out those essential ideas that will give you, the listener, a clearer picture of how investment pros approach analysis and think about returns.
Right.
Without getting totally bogged down in overly academic or super technical details.
Think of it as a shortcut.
Exactly, a shortcut to understanding some really crucial insights. We're going to look at how to really understand a company's underlying worth, what creates a genuine competitive advantage, how efficient the market actually is or isn't.
The big debate.
How to assess different kinds of risk, and even the sort of strategies behind making a compelling investment case, that pitch.
Lots to cover.
Okay, let's unpack this, starting with maybe the most fundamental concept, value. The book makes this key point early on when you're thinking about a company's intrinsic value. It's way more useful to think of it as a range of possibilities.
Yeah, not a single number.
Not one precise figure.
That's such a critical starting point.
Yeah.
The authors, they rightly highlight people like Warren Buffett, Roger Murray, Seth Klarman.
The legends.
Yeah, all of whom really emphasize that intrinsic value is an estimate. It's an informed guess based on what you expect in the future, not some hard, definitive number you calculate perfectly.
So analysts can get sidetracked.
Oh, definitely. Like a common pitfall, getting overly focused on creating these seemingly precise calculations. It can distract from the bigger picture, the qualitative stuff, and just the basic uncertainty of the future.
Okay.
Ultimately, intrinsic value all comes down to the future cash flows an asset is expected to generate, discounted back to what they're worth today.
Well, when we talk about discounting those future cash flows, the discounted cash flow model, the DCF, that's presented as the most economically sound way to do it. Right.
It is, theoretically.
But the book also points out applying it in the real world, well, that can be pretty complex.
It certainly can be. I mean, think about it projecting all those pieces of future cash flow, the timing, the amount, the duration, growth potential, the risks involved.
Over years and years.
Exactly, over a long period. It's just inherently full of uncertainty. And that's why you often see people using more streamlined valuation methods like price-to-earnings ratios or EBIT multiples.
Shortcuts.
Kind of. But what's interesting is how Sonkin and Johnson explain these simpler metrics. They're essentially just condensed versions of a DCF analysis.
Ah, okay.
They make implicit assumptions about how sustainable and predictable those future cash flows are going to be. Like EBITDA, it tries to capture the operating profit before things like debt and taxes.
Gives you a cleaner look.
A cleaner look at the core earning power, yeah.
Right.
Which you then use as a proxy for future cash generation.
That makes sense. So it's like using a shortcut, but you really need to be aware of the assumptions baked into it.
Precisely.
The book also draws this really clear line between generating cash flow from, the core operations. Their example is Mystery Ranch selling backpacks made with their sewing machines.
Right, the ongoing business.
Versus just selling off the company's assets, like liquidating those same sewing machines.
And that's a fundamental distinction, isn't it? It have huge implications for long-term value. Operating assets, they're meant to produce a continuous stream of cash flow through the regular business. That offers sustainability. Selling off assets, well, that provides a one-time cash injection, which can sometimes unlock value, sure, but it's usually the consistent cash from operations that drives a company's lasting worth.
Okay.
And this leads us into those alternative valuation methods the book talks about, like liquidation value, what you'd get if you sold everything off, and private market value.
And private market value, that introduces some interesting wrinkles. It's not just the sum of the parts. The book, drawing on Roger Murray's work, points out it can include a control premium.
What someone pays for control.
Right, what a buyer might pay extra for the ability to actually run the whole show. And even a patience factor. I found that really insightful, the patience factor, because the public market often seems so driven by the short term.
The patience factor is key, yeah. Public markets can get totally fixated on quarterly earnings, short-term news.
Definitely.
Which can sometimes lead to companies with great long-term potential being undervalued.
Yeah.
Just because it takes time for that potential to show up.
But a private buyer might see that.
Exactly. Private buyers, often with a longer investment horizon, they might recognize and be willing to pay for that future potential. The book then gets into the concept of owner earnings and how creating excess returns is the real engine of value.
Excess returns meaning?
Where a company's return on invested capital, the ROIC, consistently beats its weighted average cost of capital, or WACC.
Okay.
That's what creates value. They use a really relatable lemonade stand example for this.
Yeah, the lemonade stand analogy, it makes it really accessible. You know, Zoe starts her stand, earns great returns initially.
Right, easy at first maybe.
But unless she builds some kind of advantage, secret recipe, the best corner spot, something that stops every other kid setting up shop right next to her and competing away her profits.
Those high returns won't last.
Exactly, which segues perfectly into our next big topic, competitive advantage.
Precisely. Competitive advantage basically is just that ability to consistently generate those excess returns, that ROIC greater than WACC.
But not just for a little while.
No, the truly valuable thing is a sustainable competitive advantage.
Yeah.
Being able to keep those superior returns going over a long time. And that requires what the book calls barriers to entry.
Things that make it hard for competitors to muscle in.
Exactly. Factors that make it difficult for new players to come in and eat away at your profitability.
And the book lays out 4 main types of these protective moats, right?
Mm-hmm.
Customer-facing ones, like a really strong brand loyalty.
Cake Apple.
Production advantages, maybe being able to make things cheaper than anyone else.
Lower costs, right?
Efficiency advantages, often from economies of scale, just being bigger.
Getting bigger can make you more efficient.
And finally, advantages from government policy, things like patents or tough regulation.
Right, so the core pillars, the fundamental sources. And as the book really emphasizes, it's crucial to get this without one of these advantages.
Right.
If a company's ROIC just equals its WACC.
Just treading water.
Essentially, yeah.
Yeah.
The business isn't actually generating any additional value for its owners beyond the capital they've already put in. It's covering its costs, sure, but it's not really creating wealth.
Okay, so let's say you found a company. It looks intrinsically valuable, seems to have a solid competitive advantage. The next big question is, has the market already figured this out?
Right. Is it already priced in?
Which leads us straight into the idea of market efficiency. Always a hot topic, this one.
It certainly is. The book introduces market efficiency as the theory that basically current stock prices at any given moment already reflect all publicly available information about a company.
Meaning the price is the best guess of true value.
That's the idea. They credit Eugene Fama with formalizing the concept, and they acknowledge, the debate about how truly efficient markets are is definitely ongoing.
Sure.
But they use his framework as a useful starting point for understanding how markets work, or are supposed to work.
And all available information, that covers a lot, doesn't it? The book breaks it down into, truly public info.
Stuff anyone can find easily.
Quasi-public info may be public, but costly or time-consuming to dig up.
Takes effort or money.
The non-material, non-public info, which might give you a temporary edge in trading.
A timing advantage, perhaps.
And then, of course, the illegal stuff. Material, non-public information. Insider trading territory.
Exactly. Stay away from that. So the authors outline these 3 conditions that would need to be true for a market to be perfectly efficient.
Okay, what are they?
1, information has to be spread widely and quickly. 2, investors have to process that information rationally.
Rationally. Big assumption there.
Huge assumption. And 3, Those rational interpretations need to be rapidly incorporated into stock prices through trading.
So info flows, people think straight, and trades happen fast.
If all three of those happen perfectly, consistently, without any friction, well, it'd be incredibly hard to consistently beat the market.
Which brings us right to the holy grail for so many money managers, generating alpha.
Beating the market, risk-adjusted.
Right. And the book highlights this is basically a zero-sum game. For every investor getting above-average returns, there's probably someone else getting below-average returns.
Makes sense.
They even bring up Michael Mobusen's work on the paradox of skill.
Oh yeah, that's fascinating stuff.
The idea that as the overall skill level in a field goes up,
Like in investing.
luck actually starts playing a bigger role in who wins and loses.
It's a crucial insight. As more and more people in the market get really good at analyzing information, those easy-to-spot mispricings just dry up,
Makes it harder.
which makes understanding potential inefficiencies even more critical. And the book then introduces this really cool concept, the wisdom of crowds.
Ah, the bean jar.
Exactly. Guessing the
Right.
beans in a jar. Or even how surprisingly accurate collective predictions can be for things like the Academy Awards.
I always find those examples amazing. The idea that a diverse group acting independently
Independence is key.
can collectively arrive at estimates that are often better than any single individual's guess, even if they aren't experts.
The aggregated wisdom can be powerful.
But the book also wisely warns this wisdom isn't guaranteed, right? You need that diversity and independence.
Absolutely. They use that great example of the steer-seer at the ox weighing contest.
Right, the guy who claims he can guess the weight perfectly.
And his guess biases everyone else's, skewing the whole collective judgment way off.
Yeah, it shows how easily the crowd's wisdom can be derailed.
If people aren't thinking independently, or if too many people are influenced by the same flawed idea or bias, the collective guess can be way off.
But sometimes the crowd is wise.
Interestingly, yes. The book points to examples like Estimize.com, where the combined earnings estimates from a diverse bunch of individual investors.
Not necessarily pros.
Right. Their collective forecast for companies like Apple has sometimes been more accurate than the consensus estimate from professional Wall Street analysts.
Wow. Which really makes you think about how investors try to find an edge in this environment. The book suggests it's often about developing an informational advantage, legally, of course,
Legally, yes.
by creatively piecing together different bits of information to form insights that the market hasn't quite grasped yet.
Finding connections others miss.
Okay, so if the market isn't perfectly efficient all the time, what causes these glitches, these inefficiencies? This seems like where behavioral finance comes in.
Exactly. The book brings in Benjamin Graham's famous character, Mr. Market.
Good old Mr. Market.
Your somewhat erratic business partner, right? Who shows up every day offering to buy your share of the business or sell you his, but at prices that swing wildly based on his mood.
Total mood swings.
Oscillating between crazy optimism and deep pessimism, completely disconnected from the actual value of the business.
So when Mr. Market is euphoric, he offers sky-high prices, and when he's depressed, he practically gives his shares away.
And this emotional roller coaster, it can create huge gaps between a stock price and its real intrinsic value. Opportunities, potentially.
The book then digs into insights from evolutionary psychology, explaining how these mental shortcuts, heuristics that helped our ancestors survive,
Like reacting quickly to danger.
can sometimes lead us to make systematic errors when investing. They highlight things like representativeness, availability, anchoring, drawing on Kahneman and Tversky's work.
Yeah, those cognitive shortcuts can definitely cloud our judgment with money. Like the availability heuristic, we might overweight recent dramatic news, like a market crash.
Even if statistically it's rare.
Exactly. Even if it's unlikely to happen again soon. The book also distinguishes between this micro-level stuff, individual biases.
I would mess up.
Right. And the macro-level perspective, like Robert Shiller's work, looking at how these collective behaviors can drive market-wide things like bubbles and crashes.
And it's fascinating how these same biases can actually undermine the wisdom of crowds idea we just talked about.
Absolutely. They reduce that crucial diversity and independence. If everyone's falling prey to the same fear or greed, the crowd isn't wise anymore. It's just a herd.
The book also mentions practical limits too, right? Like not enough liquidity in a stock or maybe fund managers facing client redemption.
Yeah, real-world constraints.
Things that can stop even smart investors from acting on what they see as a mispricing, which highlights the advantage of having strong hands, permanent capital, like Berkshire Hathaway.
Those limits to incorporating information are huge. Even if you've got a great idea, you need to be able to actually trade on it and hold on long enough for the market to maybe catch up.
But even with all these quirks and biases.
Right. Despite all that, the book kind of suggests that market efficiency is still a pretty powerful force overall. They mention Richard Thaler's view that consistently beating the market just using behavioral finance insights is really, really hard.
Okay, so if the market is mostly efficient, but not perfectly, how do investors actually try to generate those returns? The book introduces Michael Steinhardt's concept of developing a variant perspective. What's interesting here is that...
What's really interesting is that a variant perspective isn't just like disagreeing with everyone else for the sake of it.
No?
No, it's about forming a genuinely different view on a company's future cash flows, a view you can back up.
Different how?
Maybe you think the cash flows will be bigger, or last longer, or arrive sooner, or grow faster than the market currently expects.
Okay.
The book revisits the Zoe's lemonade stand example here. If you have a different, justifiable assumption about her future growth, that leads to a very different valuation than the market consensus.
Got it. And to build this different view, this variant perspective, the book talks about 3 potential advantages an investor might cultivate.
Right. There's analytical advantage, basically, seeing patterns or connections in the data that others miss.
Okay.
Informational advantage, getting access to information others don't have, though they stress the legal ethical lines here, obviously.
Very important.
And trading advantage, being able to execute trades when others can't, maybe due to size or liquidity issues.
They had some good examples here. The Twitter earnings leak.
Perfect example of informational advantage, yeah. Those who acted fast on that unexpected news had a clear short-term edge.
And the engineered virus color blindness analogy for analytical advantage.
That's a clever one, isn't it? Being able to see something, a pattern, an implication that others literally can't perceive because of their existing mental models or biases.
Yeah.
They even mention information cascades, like the whole Ackman Herbalife battle, how investors reacting to each other's actions and opinions can sometimes drive prices away from fundamentals, at least temporarily.
And the Cloverland Timber example seemed to tie a lot of this together.
It really did.
Yeah.
Here you had a company that looked cheap on the surface.
Right.
And a deeper dive, a detailed analysis of its main asset, the timberland, gave a variant perspective. It was based on a more accurate appraisal than the market seemed to be using.
So it showed how errors in analysis may be combined with low trading liquidity.
Can create these potential mispricings. But it's also a good reminder about value traps, right?
Where it looks cheap but stays cheap.
Exactly. Where the thing you expect to happen to unlock the value just never does.
That Cloverland example really drives home the need for deep, independent research. Don't just rely on the headlines or what everyone else thinks.
Absolutely. Now, once you've done that work, developed your variant perspective, and you think you've found a compelling opportunity,
Yeah.
how do you think about what could go wrong? Let's shift to assessing risk.
Right. And the book makes this really critical distinction early on between uncertainty and risk.
Very important difference.
Uncertainty is just, the future is unknown. We don't know what will happen. Risk, though, that's the actual possibility of losing capital.
Yeah.
Risk only really enters the picture when you commit money to that uncertain future. Like their example, if your grandma gives you a lottery ticket, there's uncertainty, but no risk to you.
You didn't pay for it.
But if you buy that same ticket, now you've got both uncertainty and risk.
That's a crystal clear way to explain it. And the book really hammers home that the amount of risk you take is tied directly to the price you pay.
Your margin of safety.
Exactly. The more uncertain those future cash flows seem, the wider the possible range of intrinsic value estimates.
Makes sense.
And so the more crucial it becomes to demand a significant margin of safety in the price you pay, just in case your estimates are wrong.
They also stress the importance of the time horizon, don't they?
Hugely important.
Yeah.
It's not just about what you think the stock might be worth eventually, but also how long it might take to get there.
Right.
They break down investment return into 3 key parts: the price you pay initially, your estimate of the ending value, and the time horizon over which you expect that value to be realized.
And getting better at estimating value and the time horizon?
Can significantly reduce your risk. More accuracy, more precision in those estimates helps a lot. They also touch on a very real risk for professional managers, just underperforming their benchmark index.
Yeah, career risk.
That pressure to keep up with or beat a benchmark is always there in the professional world. Okay, so let's imagine you've done all this hard work. You found a company you think is valuable, it's got a moat, you have a variant perspective, you've thought hard about the risks. Now comes the final crucial step, communicating that idea effectively.
Getting someone to actually put money behind it, usually a portfolio manager.
Exactly. This is where the book gets into the art of the perfect pitch.
And this section I thought was incredibly practical. It really stresses that a successful pitch isn't just about laying out facts and numbers.
No, it's more than that.
It requires really understanding the portfolio manager's goals, not just their stated investment strategy, but also, maybe even more importantly, their unspoken subjective criteria.
This stuff they don't write down.
Yeah, they use this memorable dream summer house example. You know, even if a house checks all the objective boxes, right number of bedrooms, right price, if it doesn't feel right based on the buyer's unstated dream, they won't buy it.
That summer house analogy, it really hits home, doesn't it? It's about making a connection, understanding the hidden motivations and preferences of the person making the decision.
Totally. The book then lays out this really practical 3-part structure for a good pitch.
Okay.
A quick, 30-second hook to grab their attention immediately, make it compelling, maybe even, as they say, greed-triggering.
Get them interested fast.
Then a focused 2-minute drill. Lay out your core arguments, and importantly, proactively address the key concerns you know they'll have.
Anticipate the pushback.
And finally, the Q&A session for the deeper dive, fielding more questions. They even mention Milo Frank's classic book on getting your point across quickly.
Yeah, that's a good reference.
I really liked the real-world examples they used too, like Paul S. pitching MIDI Light to Chuck Royce, or that iconic scene in Wall Street, Bud Fox pitching Blue Star to Gordon Gekko.
Yeah, Gecko. Classic.
Toth really show the power of a strong hook and a clear, concise story. The book then introduces the Toulmin model of argumentation.
Toulmin. Useful framework.
As a way to build really solid, well-supported investment arguments. You know, with the claim, the data, the warrant connecting them, the backing for the warrant.
It gives you a structure, helps ensure your argument is logical, well-reasoned, and can stand up to questioning. The book really stresses how vital it is to anticipate those questions.
Know your stuff inside out.
Absolutely. Have encyclopedic knowledge of your idea. And craft a simple but impactful slide deck. Brief, focused on the key points, and directly answering the PM's main questions.
They even get into nonverbal communication, which I found interesting.
Yeah, the soft stuff matters. Body language, grooming, how you dress. It all sends signals about credibility, competence, likability.
Right. They mention studies on first impressions, even the difference between a custom suit and off the rack.
Subtle signals, but they can have an impact. And they warn about those little micro-expressions that might betray a lack of confidence, even if you don't realize you're making them.
It really highlights that a great pitch is about building trust. Showing you've done the work, yes, but also that you understand the portfolio manager's world, their pressures, their philosophy.
Even the unstated parts.
Exactly.
Ultimately, a compelling pitch, it's about more than just the idea itself. It's about giving the person across the table confidence in you and showing you understand their perspective, what drives their decisions.
So, as we wrap up this deep dive, we've really journeyed through Pitch the Perfect Investment. We looked at viewing value as a range, understanding competitive advantages, the whole market efficiency puzzle, and the hunt for alpha.
The behavioral finance side, too, how our own minds can trip us up.
Right. The need for that variant perspective, how to think about risk comprehensively, and finally, the art and science of the pitch itself.
And as we've kind of threaded through, becoming truly well-informed here means seeing how all these pieces connect.
It's not just one thing.
No, you can't just understand valuation in a vacuum. You need to see the interplay between value, moats, market psychology, risk. It all fits together.
Okay, so here's a final thought for you, the listener, to chew on. Think about that constant tension between how efficient markets are supposed to be and how irrational investors, well, we often are.
Yeah.
How does that push and pull create opportunities or maybe traps in the investment world? And maybe take it a step further. How might your own biases, those mental shortcuts we talked about, be shaping how you see risk and value?
Not just in investing.
Not just in investing, but in all kinds of decisions you make every day. Something to reflect on.
Definitely food for thought.
Thanks for joining us for this deep dive.